There's no question the private equity firms have come into this space, and we are no longer competitive in this space.
In recent years, large private equity firms like Blackstone, Apollo, and KKR have aggressively expanded into insurance, raising permanent capital, managing float, and aiming to replicate the model that Berkshire pioneered decades ago. Given that these firms are now directly competing for insurance assets, often using higher leverage and more aggressive investment strategies, how do you view their impact on Berkshire's insurance operations and underwriting discipline? Do you believe that the private equity model poses risks to policyholders in the broader financial system?
There's no question the private equity firms have come into this space, and we are no longer competitive in this space. We used to do a fair amount in this space, but in the last 3-4 years, I don't think we've done a single deal. You are right in identifying the risks in these private equity firms are taking on, both in terms of leverage and in terms of credit risk. And while the economy is doing great and credit spreads are low, the private equity firms who've taken the assets from very conservative investments, and I wouldn't say high octane, but they've certainly invested these assets in situations where they get a lot more return on the investment. And as I said, as long as the economy is good and credit spreads are low, they will make money. However, there is always the danger that at some point the regulators might get cranky and say, you know, you're taking too much risk on behalf of your policyholders. And that could end in tears. We do not like the risk reward that these situations offer. And therefore, we put up the white flag and said, you know, we can't compete in this segment right now.